Filing taxes can feel overwhelming even in the best of times, and 2025 brings new rules, updated deductions, and shifting regulations that taxpayers must navigate carefully. Whether you're filing a simple return or managing a complex financial situation, a single mistake can lead to delays, audits, penalties, or lost refunds. Thankfully, many of the most common tax mistakes are easily preventable with a little preparation and attention to detail. Understanding what to watch for ensures that you maximize your refund, or minimize what you owe, while staying on the right side of the IRS. In this video, we'll break down the top 10 mistakes to avoid when filing your 2025 taxes, so you can file with confidence and keep your financial life on track. 1. Filing with incorrect or missing personal information. One of the simplest yet most damaging mistakes is filing your tax return with incorrect or missing personal information. Your Social Security number, SSN, full legal name, and banking information must match exactly with what's on record with the Social Security Administration in your bank. A minor typo, such as a misspelled name, transposed numbers in your SSN, or an outdated mailing address, can trigger processing delays or even rejected returns. Always double-check your personal details before submitting your return and update any outdated information with the relevant agencies before you file. 2. Overlooking new tax law changes. Each year brings changes to the tax code, and 2025 is no exception. From shifts in standard deduction amounts to updates in retirement contribution limits and expanded tax credits, not staying current with the latest changes can cost you money. Some deductions or credits you relied on in previous years might have expired or changed, while new opportunities may now be available. Research the 2025 tax updates or work with a tax professional who understands this year's landscape to ensure you're taking full advantage of available benefits while complying with the latest rules. 3. Misreporting income. Many taxpayers accidentally underreport or overreport their income, which can cause serious problems down the line. Income isn't just what you earn from your full-time job. It includes freelance work, rental income, investment gains, side hustles, gambling winnings, and more. Failing to report all income sources, even small amounts, can trigger audits and penalties. Carefully review all your tax documents like W-2s, 1099s, and brokerage statements, and remember that the IRS also receives copies of these forms. Keep thorough records and report every penny accurately to avoid scrutiny. 4. Missing out on eligible deductions and credits. Another common mistake is overlooking deductions and credits that you qualify for, leaving valuable money on the table. Many taxpayers miss deductions for student loan interest, medical expenses, educational expenses, retirement contributions, or even home office use. Similarly, refundable tax credits like the Earned Income Tax Credit, EITC, or the Child Tax Credit, CTC, can dramatically reduce your tax bill or increase your refund. The eligibility criteria for these benefits often change, so make sure to thoroughly review the options or consult a professional to capture every advantage you qualify for. 5. Filing too early or too late. Timing is everything when it comes to taxes. Filing too early can backfire if you haven't yet received all your necessary forms, leading to an incomplete or inaccurate return. On the flip side, waiting until the last minute can increase your chances of making careless errors due to rushing, and it can also lead to missed deadlines, resulting in penalties and interest charges. Ideally, you should wait until you have all your documentation in hand and have had time to review it carefully, then file well before the deadline to reduce stress and leave time to address any unexpected issues. 6. Choosing the wrong filing status. Your filing status affects everything from your standard deduction amount to your eligibility for certain credits, so choosing the wrong one can lead to paying more taxes than necessary or triggering IRS questions. Some taxpayers incorrectly file as single when they qualify for head of household status, which has more favorable tax treatment. Others mistakenly file jointly or separately without understanding the financial implications. Review the definitions carefully and select the filing status that accurately reflects your living situation and dependent support for 2025. 7. Neglecting to report cryptocurrency transactions. As cryptocurrency becomes more mainstream, the IRS is paying closer attention to digital asset transactions. If you bought, sold, traded, or received crypto during 2025, you are required to report it, even small or seemingly insignificant transactions. Failing to disclose crypto activities could result in significant penalties, especially since crypto exchanges are now required to send detailed transaction records to the IRS. Make sure to track your crypto activities throughout the year, and use reputable software or professionals to calculate your gains and losses accurately. 8. Forgetting to sign and date your return. It might seem unthinkable, but thousands of taxpayers each year forget to sign and date their paper tax returns, causing unnecessary delays. The IRS treats unsigned returns as invalid, meaning your filing won't be processed until you correct the mistake. If you're filing electronically, the digital signature process helps prevent this error, but if you're mailing in your return, be sure to double-check that every required section, including the signature lines, is properly filled out. If you're filing jointly, both spouses must sign the return. 9. Not keeping copies of your return and documentation. After filing, many people mistakenly assume they can toss their tax paperwork. However, you should always keep copies of your tax return, W-2s, 1099s, receipts, and supporting documents for at least 3 years. These records are essential if you face an audit, need to amend your return, apply for loans, or verify your income for other purposes. Organized documentation not only protects you legally but also saves you from massive headaches if questions arise about your 2025 return in the future. 10. Relying too heavily on software without understanding your return. Tax software has made filing much easier for millions of people, but it's dangerous to rely entirely on technology without understanding what you're submitting. Software is only as good as the information you enter, and inputting incorrect details can result in costly errors. Additionally, tax laws are nuanced, and automated programs can miss deductions or misclassify income if you don't know what to look for. Even if you use tax software, take the time to read through your completed return before submitting it, and seek professional help for complicated tax situations to ensure accuracy and compliance. Filing your taxes correctly in 2025 requires more than just filling in the blanks. It demands careful attention to detail, up-to-date knowledge, and a commitment to accuracy. Small mistakes like entering the wrong social security number or missing a signature can delay your refund, while larger errors like underreporting income or ignoring cryptocurrency requirements can result in audits and hefty penalties. Thankfully, most common tax filing mistakes are entirely avoidable with a little foresight and preparation. By being aware of these top 10 pitfalls and taking proactive steps to avoid them, you can make tax season a much less stressful experience, and keep your financial future strong. Whether you're filing on your own or seeking professional assistance, knowledge is your most powerful tool for a successful 2025 tax season.